Okay guys, good evening. My name is Isaac John, and very quickly I won't make this video so long. I'll make it as short as possible. Today we'll be talking about candlestick and time frame. Candlestick is a method to read the charts. All these things you are seeing here are candlesticks, and they made up the chart. This interface you are seeing here is our chart. Each of these green and green and red things you are seeing here, each of them are candlesticks. Each of them are candlesticks, and these candlesticks are readable. They are readable, uh, and every of these candlestick represents the time frame. Like this, okay, you can see the time frame here. We have 1 minute. We have 5 minutes. You have 15 minutes. We have 30 minutes. 1 hour, 4 hours, 1 day, 1 week, monthly. Now this is 15 minutes, for example. It means that every candlestick you see here, each of these candlestick represents 15 minutes. They are formed after every 15 minutes. If it is 1 minute, every candlestick will be formed after 1 minute. If it is 5 minutes, every candlestick will be formed after five minutes. So your time frame determines when a candlestick closes and opens. Okay, let's come to here. Now, there are components of candlestick. This is just one of the candlesticks. Candlestick is made up of two components, which is the body and the wick. The body and the wick. This is the body. This is the body for buyers, because buyers, green represents buyers, red represents sellers. This is the body of this candlestick. This is the body of this candlestick, and this is the wick of this candlestick, wick or shadow. This is the wick or shadow of these candlesticks. Now, candlesticks has an open and close. They have an open and they have close. So every 5 minutes, let's just assume this is a 5 minute candlestick. Every 5 minutes, a new candlestick will open. That is the open. Now, for bullish candlestick, which is this green, it can be called bullish candlestick. The red can also be called bearish candlestick. This green, every 5 minutes, if we are using a 5 minute time frame, for example, remember there are a lot of time frames. In 5 minute time frame, in every 5 minutes, this opens. It opens here, and buyers will buy to this part, and it will close here. Then that will happen within 5 minutes. The same thing happens to sellers or bearish candlestick. It opens here and sell down to this part and close here within 5 minutes, depending on your time frame. But here we are using 5 minutes. So it opens here, is sold to this place, then closes here. That is how the body of the candlestick is formed. Then you may be wondering, what is this wick? This wick here, what does it stand for? It is a rejection. It is a rejection. Now, the bullish candlestick opens here and buy to this point. When it buys to this point, sellers came in, because it is like a battle in the market. People are buying, people are selling, a lot of activities is happening. Then when it gets to this point, this point, remember at a point all these things was green. All these things was green before. everything was green. Everything was green before. There is no wick. Then when sellers came in, sellers now drag it to sellers now drag this green. Sellers now sell and the market closes here. It's like a rejection. The sellers are rejecting the movement of the buyers. It's a battle. The same thing happens here. It was selling, then buyers came in and start buying to the top. I don't know if you are getting it. Then the same thing happens to this sell. The price opens here and was buying, bought to this point, then sellers came in and dragged the price down to this point. Then buyers now came in and drag it to this point before the market closes here. So that is what happens in the market when you see things like this. Okay, let me show us something. Now you can see here that the market opens here. The market opens here and sold to this point, before sellers came in and dragged the price up before the thing now close here. I don't know if you are following. The price opens here and sold to this point. Then sellers came in and rejected the price to this point. Then the market closes here. The same thing happens here. The price of the market opens here and bought to the top. Then sellers came in and dragged the market down. Then it closes here. It's a rejection, it's a battle within buyers and sellers. So and as I said before, every candlestick represents a particular time frame, which is, it can be any time frame of your choice, 1 minute to any minute you want to set it to. Now there are ways you don't trade. If you see this chart now, there are ways you don't trade. You don't just look at charts and say, oh, since there is green here, it seems I'll enter this market. Oh, then there is green here, you now enter here. Before you know, red will start coming and you run on a loss, because you are supposed to move in the direction of the trend. We'll get trend as we proceed. You are supposed to trade in the direction of the market. So if the market is buying, you are supposed to be buying. If the market is selling, you are supposed to be selling. Okay, let's check here too. Let's say you see this green, this red, you see another red, and you say, it seems you have to sell this market too, because everything is red. Then you enter market here, boom, it will leave you on a loss. You don't trade like this. Or you see this red, and you say, there is a lot of red, oh, I want to enter this market. Then you enter the market here. What happened next? Boom, the thing go against your direction and it will leave you on a loss. They don't trade like this. There is this thing called confluences. They call it confluences, and there is an analogy for it. I will use sorry I will use TAE as my analogy for this. TAE, which is TAE. This T stands for trend. The A here stands for area of value. Then the E here stands for entry trigger. But first, we'll be looking into entry triggers. Then later we'll come back to trend and okay, let's start from no, let's look into entry triggers. Entry triggers are what you see, the candlesticks you see before you enter the trade. You don't just enter the trade because you are seeing green, 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 then you buy, or you are seeing red, 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 then you sell. No, you don't enter trades like that. You wait for confluences to occur before you enter the trade. Now let's look into some entry candlesticks. This is number one. This is an engulfing candlestick. An engulfing candlestick is when there is a red candlestick is forming, then the next candlestick is bigger. When we say engulf, engulf is to swallow. To engulf something is to totally cover something or to totally swallow something. It is an English word. So, yeah, sometimes in biology, those years, they will say some fish used to feed by engulfing smaller fishes. So they used to feed by swallowing smaller fishes. So engulfing candlestick, you can see that the first candlestick, there are two engulfing candlestick. Okay, here, this one is bullish engulfing candlestick. This one is bearish engulfing candlestick. Now you can see that this first candle is smaller, then this one is bigger, and this one swallowed this smaller one. This one engulfed this one. This is a bullish engulfing candlestick. Then on the bearish one, you can see that this one is smaller, then this one is bigger. Then you can see that this one swallowed this one. These are engulfing candlesticks. There are places where this thing will occur and it will tell you that you are supposed to buy or you are supposed to sell. And let me bring it to your notice that you don't trade candlestick on isolation. You cannot just trade candlestick because you see engulfing candlestick, you just buy or you just sell. No, it doesn't work that way. There are a lot of things you need to look out for. That is where TAE comes to play. We are getting there. Then let me show you another one. This is still a bullish engulfing candlestick, but in this case you can see the high, you can see the low of the bearish. This is a bearish, as I told you. Red is bear, green is bull. So you can see that the market opened here and sold to this point, then closes here. That low is the lowest it got to before market buyers started fighting the sellers. Then that high is the highest it got to before sellers started fighting the buyers. The same thing happens to this one. Same thing happens to this one. It opens here and bought all the way and closes here. Then you can see the highest it got to before sellers started fighting them. You can see the lowest it got to before buyers came in, and you can see that this one swallowed this one. So this is a bullish engulfing candlestick. Okay, let's still proceed to So when you see this formation, you are supposed to enter a trade, but you still need some confluences to assure you that you can enter. You don't just enter a trade solely based on candlestick. Okay, this is a bearish candlestick. You can also see that this one swallowed this one, engulfing bearish candlestick. Okay, let's still proceed. Now that one is bearish, that one is engulfing candlestick. Then this one is hammer. You can see that there is a long wick or a long shadow. This is where the market opens for this one. The market opens here and was selling. Initially it was red here like this. It was red. All these things was red. Okay, initially it was red. Here like this. Big red candle here. It was red. Everything was red. Then what happened? It was a big red candlestick. Then what happened? Buyers now came in and they started fighting the sellers. So it was now buyers that pushed the market and left these traces. These traces here. It was buyers. It's a rejection. So they call this one hammer. When you see this one, it tells you that the market is about to reverse. Like the market was selling before, then buyers came in. The same thing applies to this one too. The market opens here, then sold to this place. It was a big red candle before, same as big red candle. Then buyers started pushing the price until it became this. Here too, buyers pushed the price until it became this. So anywhere you see this hammer pattern, just prepare to buy, coupled with some confluences which we will soon get to. Then the opposite of this one is called shooting star. The opposite of this one is called shooting star, or inverted hammer instead. So then this is hammer. You can see the full body and you can see the wick, which is the rejection or the fight that drove price back to the upside. This is also hammer. Now see what is happening here. You can see that price was coming down, 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 down. Then when it got here, it was supposed to come down. But what happened? Buyers came in and they pushed price to the upside. You can see the rejection. Buyers said, no, we are tired of sellers. Let's push up price up to the back to the upside. Then you can see there is a hammer here. Then what happened after that hammer? Price started going up, 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 up. So it's a rejection candle that tells you that price is about to go up. Then let's see this one, doji. This one is doji. This one is indecision. Indecision is the same as not agreeing, on agreement. It's a fight. Nobody is deciding. No buyer, no seller. At this point, even the market itself is confused. Now, let me say something. The market opens here and closed here. What happened here is when it opens here, it bought to this side, then sellers came and sell to this side, then buyers came and buy again, and at the end of the day, buyers didn't win, sellers didn't win. It ended here, indecision. They call this one doji. There are places doji will occur, then the next candlestick will determine the trend of the markets or the direction of the market. So so this is indecision. The buyers didn't win and the sellers also did not win. So you can see there's neutral. There is neutral. You can see there is neutral. This is a neutral candlestick. This long leg also is like a neutral candlestick. Then there is gravestone and dragonfly. This gravestone is the price open here. The price open here and sold to the upside. But what happened? Sellers brought price back to where it's open and it closes here. Then dragonfly also, price open here and sold to the downside. Then what happened? Buyers came in and bought to the upside. So these are indecision. Then what happened next determines the trend of the market. So this is still dojis. You can see the high, you can see the low, you can see the open and the close price, that they are in the same place. They are in the same place. The high is the highest the market got to before the opponent came in. Then now this is a doji. As I said before, the what happened next determines the trend of the markets. Now at this point you can see that the market is selling. From here is a downtrend. The market is selling, is selling, is selling, is selling. Then at this point there is an indecision. Though there is a doji there, an indecision. So when this thing forms, let's assume all this one has not formed yet. Let's assume all this ones has not formed. Sorry. Let's assume all these ones hasn't formed yet. All these ones, let's assume they've not formed. So at this point, we don't know what is coming next because there is an indecision in the market. Buyers didn't win, sellers didn't win. So we have to wait for the next candlestick to form. So whatever the next candlestick says is what we will follow. Like after this indecision, what happened next? Buyers won. Buyers won. So what happened after this candlestick? We see that price started going up. So indecision in the market is doji. Now, indecision is the market is doji. We are still on doji. Then there is a morning star. This is actually a morning star formation too. But let me use this one to explain what morning star is. Morning star is three candlestick together. Three candlestick together. Let's say a sell candlestick, then a doji, then a buy candlestick, then a buy candlestick. This is morning star, and you can see that it occurred here. A sell candlestick, a buy candlestick, and a doji. So this is morning star. When a sell market is selling, then a sell candlestick happens, then followed by a doji indecision, then followed by a buy candlestick or a bullish candlestick. Now this is still it here, a sell candlestick followed by a doji, then followed by a buy candlestick. But this small body, this small doji, it can be doji, it can still be a small body candlestick. But this is a formation of morning star. When this occur, know that there will be a reverse in trend. But you cannot trade you cannot trade in isolation. You cannot trade without using other confluences. Okay. This is also a morning star. You can see our sell. You can see the sell candlestick. See the sell candlestick. See the doji. See the buy candlestick. It signifies a reversal, a trend reversal. Then the opposite is an evening star. The opposite is an evening star. This is how evening star looks like. A bullish candlestick followed by a doji, then followed by a a a bearish candlestick. This is an evening star. So there is morning star and there is an evening star. Okay, let's keep proceeding. Okay, this is an evening star. You can see the bullish candlestick, the doji or the small body candlestick, then the bearish candlestick. When you see this, just know that price is about to go down. Okay, we are still proceeding, we are almost through. Now you can see here you can see evening star pattern form here. You can see evening star pattern form here. The last green here is the green I was talking about, followed by a small body candlestick, then followed by a bearish candlestick. So you can see the tree is just small here. That is an evening star, an opposite of morning star. Okay, so another confluence is again is tweezer bottom and tweezer top. It's usually like this: tweezer bottom, then it will have a wick, then another one again, so have another wick here. These two, they are tweezer bottom, then tweezer top used to be like this. Tweezer top used to be like this. Why is this a confluence? You can see that there is a price rejection twice here. Price got to this point, then rejected. First one. Then after that candlestick has closed, then price still got to this point, still rejected. You can see now that the opponent is not, they're not smiling at all. The same thing here. Price got to this point, rejected. Same price got to this point, still rejected. So now you can see that there is about to be a rejection in the trend of the market. Okay. Now let's look at the examples. Okay, I was talking about the TEA. The TEA I talked about was the T stands for trend. The T stands for trend. Trend is the movement or the direction of the market. The direction of the market, if it is going up or it is coming down. Now, for this one, you can see that the price is going up. The price is going up. Okay, that is the trend. Then there is another one called TEA. Remember, the A there is the A there is area of value, area of value, area of value, area of value. Now let's look at areas of value. You can see that this trend line here, this line here, this trend line here, you can see that at this point price or candlestick came to touch it, then it came here again to touch it, then it came here again to touch it. What is it telling you? It is telling you that when price comes closer to this thing, this thing is an area of value. Like there is a repetition of action in that area every time price gets to that place. So when you want to enter a trade, now we know what TEA means. What TAE means: trend, area of value, and the E symbolize entry trigger, which we talked about with the candlestick. Now this is an example. What happened here is, if we want to enter a trade here, first thing we will look out for is the T, trend. Did we see trend here? Yes, we can see an uptrend. Another thing you can use to check if the market is going down or is coming up is moving average. Let me show us moving average. Let me use USD to show us moving average. This is my moving average. This is my moving average here. This is my moving average here. This long thing here is my moving average. When price is above it, this is price. This is price, or the current price of the market. When price is above this thing, it is an uptrend. It's an uptrend. When price is above it, is an uptrend. If price is below it, it is a downtrend. See, this is price. This is price, and you can see that price is below it. This is price, and you can see that price is below it. So this one is a downtrend. That is how you know either we are having an uptrend or a downtrend. But here, for this example, we are having an uptrend because price is above this moving average. So TAE. Did we see T, which is trend? Yes, we see trend. We see trend. That is one. Two, did we see area of value? Yes, we see area of value, which is here. We hit it here. It hit it here. Then we know that the next one it will hit it, we are supposed to enter the market. So this is an area of value. But yeah, this is an area of value. So did we see area of value? Yes. So at this point, when it happens here, one, it happens here, two. At this point, we are supposed to enter this market. You get? That is E. Now, when it gets closer to this line here, what are we supposed to be looking out for? We're supposed to be looking out for trigger, entry trigger, which is one of those candlestick we talked about. Now we have seen trend, we have seen area of value. Now we are looking for entry trigger. What happened here? We see engulfing candlestick. So when price come closer to this line, we look for engulfing candlestick, we look for shooting star, morning star, hammer. Once we see any of those things, we can enter a trade. Now, then after we have entered this trade, when we've seen engulfing candlestick, we'll go up again and it come down and another engulfing candlestick occur here. So let's see another example. This is a trend line also. This thing here is a trend line also. So that's a trend line also. So did we see trend here? Yes, it is uptrend. It is uptrend. And did we see area of value? Yes. After it touches it here, it went up, then came down again and touched it here again and went up. So we are waiting for it to touch it here again and go up. That is what we should be waiting for. So when it came here, what did we see here? We saw hammer. Then after that hammer has formed, immediately the next candle opens, we are entering that trade to buy. For this particular example here, then let's see another example. Did we see trend here? Yes. We are still using trend line, uptrend. We see trend and we see area of value that it keep touching repeatedly, keep touching that place. Then at this point, when it goes up and come down here, we know that it is already in our area of interest. Then we start looking out for entry triggers. Immediately there is an engulfing candlestick or pin bar or any of those candlestick we mentioned. After that candle has formed, they are supposed to enter the trade. But what happened here? Engulfing candlestick formed here, and we enter. See it again. It doesn't necessarily have to touch your entry, your zone, which is the area of value. It doesn't necessarily have to touch it. Now you can see there is an engulfing candlestick here too, but it occur near your entry point, which is your near your zone, which is near your area of value. It occurred near it. So if you are smart, you would have actually taken that trade also. So let's keep seeing if we have another example. Okay, in this example, what happened here is there is a trend line here. Don't worry, we'll get to the part where we do support and resistance. What happened here? When price got here, it dropped. It got to this place again, it dropped. Then what are we supposed to be looking out for? Immediately get to this place again, we are supposed to enter the trade for it to drop. Do you get? But mind you, this is a support. This is supposed to be a this is a resistance. This is a support. But we'll get there. So you can now see that this is your zone. This is your area of value. This is also an area of value. Now, when price has touched here and touched here, what are we supposed to do? The third time price touches here, we are supposed to enter or look out for confluences before we enter. So here, at this point, you're supposed to be looking out for either shooting star, morning star, engulfing candlestick, hammer, or whatever. But what happened here is shooting star, which is inverted hammer. It's supposed to be hammer, but an inverted one. So after this shooting star has occurred, we are supposed to enter this trade. Let's see if we still have more examples. Okay, I think this is the last example we have here. And you can see from here that we have area of value here. We have area of value here. Why is it an area of value? I didn't see what happened in the past. But this is an area of value. And you can see price touch here, then drop. Price touch here again, then drop. I think price has touched it before, because you are supposed to trade the third touch. But if you are smart and you saw some other things, you can catch the first touch, you can catch the second touch. Then when price come here again, this same zone, you can now look out for entry trigger, then sell. But when price got here, touched here, then touched here, you can see tweezer top. The price rejected the first time, rejected the second time. Immediately that market closes, you're supposed to enter this trade like a madman. So this is how candlestick works, and I believe you know that time frame, one candlestick represent one time frame, depending on whichever time frame you want. So in recap, what have we been able to learn today? We've learned what candlestick is, we've learned component of candlestick, we've learned the open and close and the high and the low of candlestick. We know what buyers and seller and what they represent, bullish and bearish, and the rejection patterns and how rejection works. And we've been able to learn what time frame is from this video. And also we've discussed five uh five out of many entry triggers. Just discussed five. And we talked about confluences, which is the TAE ideology. And we also talked about examples of how to enter a trade using all these things we've talked about. So at this point, I will say good evening once again and enjoy the rest of your night. Bye bye.